Hi, I'm Mark Hebner, President of Index Fund Advisors, and welcome to IFA.com television, where we're going to discuss market declines and volatility today, one of the favorite topics of investors. Well, the first thing you have to understand about market price changes, volatility, declines, increases, whatever it might be, is that all prices reflect all available information all the time. Here's a nice little graphic put together by the good folks over at Dimensional. It shows you on the left here that all available information is visible and available to market investors around the globe. We estimate maybe 10 million traders in any one day. They take all this information and combine it into a companies' prospects for the future, their uncertainty about those expected returns for those companies, and they resolve a price through a process called price discovery, actually. And that price is then a reflection of all of this information and the aggregate expectations about risk and return for these particular securities around the world. If we were to go back and look at market declines, what you might call a crisis, going back here to 1987, it looks like. One thing you might ask yourself is, how long did it take to recover after this decline? And so we have a nice little graphic here that gives different market declines, and let's just talk about them briefly. Way back in October 1987, which was a couple of years after I actually sold my company and received quite a windfall of cash, I remember it very clearly, we had a stock market crash that was largely driven by insurance products in the market, where people were trying to insure themselves from market declines. And what we show in this chart is what happened a year, 3 years, and 5 years after the sort of crisis that occurred in the market. Now, these are total returns over those periods, but you can see in particular the light blue line, which is the 5-year return, all look very positive 5 years after the crisis. So let's look at this first one back in October 87. 1 year later, the market was up 19%. 3 years later, it was up 33%. And 5 years later, it was up 76%. How about the U.S. savings and loan crisis back in August of 1989? A year later, it was still down about 2%, but then 3 years, we were up 23%, and by 5 years, we were up 61%. We had the Asian contagion, Russian crisis, and long-term capital management collapse. 1 year later, we were up 16%. 3 years, 25%, and 52% 5 years later, roughly 10% a year on that 52%. The dot-com crash lasted a little longer. That was March of 2000. I also remember that very well because we started our company in actually March of 1999, but we didn't really trade in client accounts till November. So it wasn't long after we started that the dot-com crash came along. And you could see a year after, you were only up 2%. Even 3 years later, you were only up 2%. But 5 years later, we had pretty good comeback, and you were up 51%. So then averaging about 10% again over those 5 years. That's not considering compounding. In September 2001, we had the horrific terrorist attack on the U.S. You can see a year later we were still negative about 1%, but at 3 years we were up 40%, and at 5 years we were up 81%. Now, the other thing you have to keep in mind is 5 years forward, there's lots of other news that occurs, and by the time you get that far out, the impact of the crisis has faded substantially and could have been replaced by a number of other positive events that occurred in the economy. In September 2008, we had the well-known global financial crisis. They label it here as the bankruptcy of Lehman Brothers, which was one of the more substantial crisis events during that period. A year later, we were up only 4%. 3 years, we're up 12%. And at 5 years, we're back to almost that 50%, 47% to be exact. And so look at all these 5-year returns. They're all quite substantial and something you should be keeping in mind. Now this chart does something a little different. This is now looking what happens after we reached a market high. Over the years I've been doing this now, almost 22 years, I can tell you that we hear from clients after a market decline, they're worried, and many clients after a market high, they're worried that the market's going to crash at some point in time, and oh my gosh, what do I do? Maybe I should get out. And so we've got two charts here that deal with this concept of trying to time the market based on what has happened in the past. This addresses this idea about going. You hear on CNBC and Bloomberg that the markets are going down or going up. There is no going, there's only gone. And the reason the going is eliminated is the fair price that's reached in markets, as I showed you on that first image. If we're always starting at a fair price, there's an equal chance that the next price will be above or below the fair price to generate the fair return. So that's a little bit complicated, but remember, the buyers of securities are taking on this risk, and therefore they have a positive expected return that's based on the risk of the investment. So when we say that markets have an equal chance to go up or down, that's relative to the fair return. So let's take a look at this chart. This is after we reached a monthly high in markets that hasn't been obtained in the past. And here we can see that a year later, after reaching those highs, the annualized return was 13.9%. 3 years later, after reaching that high, it averaged 10.5% annualized return. And at 5 years, 9.9%. Now there's that 10% again, much like we saw in the last chart. Although the last one was a 60-40 portfolio, this one is the S&P 500. So now look at the similarity of this data. This is the average annualized return after a market decline of more than 10%. So once again, people have seen a 10% decline. They go, oh my gosh, the market's going down. There is no such thing as going. So what happened here? A year later, the average annualized returns were 11%, 11.3. 3 years, they were 10.2, and the 5 years were 9.6. No going, okay? Other than going in a direction that is sets the expectation for investors to be properly rewarded for the risks they've exposed their assets to. So, trying to pick the fastest lane when you're driving is a very stressful activity in traffic. It's kind of the same thing in investing. To try to move around, oh, the lane's going this way, we better go over here, it's going faster, market's going up or going down, maybe we should move ourselves around. All that's doing is adding anxiety, and you actually have to get lucky several times, actually. Decide when to get out, when to get in, and then if you want to continue to play that game, it is only a matter of luck as to whether you'll do better than just a buy and hold type investment. So, a couple reminders here is that nobody can reliably forecast the market's direction or predict which stock or investment manager will outperform. That's a pretty bold statement, given the fact there's an entire industry who charges clients to do just that. There are a number of studies, we have them in my book, we have them on our website, that document this. And you might be saying, well, wait a minute, what about this guy, what about this gal who actually did it in the past? Well, what the academics have concluded in looking at these past winners is that it was just a chance outcome, a lucky bet, if you will, at a particular point in time that worked out for them, but there is a lack of consistency of this performance, or what's often called by the academics a lack of persistence of performance. So a financial advisor can help you stay disciplined in your investments by creating an investment plan that will focus on actions that will drive your positive expected returns going forward and avoid making these volatility mistakes that we see often in investors. So what are the things that we can actually control in our investments that help us be better investors? First of all, we can diversify. We can spread out these risks so we are subjected to less volatility and less concentrated bets, if you will, on the market. The other thing we can do is make sure you're in a risk-appropriate level of risk exposure or investment allocation, if you will, stocks and bonds in a mix such that the volatility is something that you're actually comfortable and capable of holding. We can also focus on a good investment strategy going forward, which would include buy, hold, rebalance, slowly reduce your risk over time through a glide path, and when opportunities present themselves, engage in a tax loss harvesting investment strategy. You also want to keep your costs low, and you can do that through a passive investing strategy. And lastly, you want to stick to your risk capacity and spend your risk budget wisely. Your risk budget is basically how much risk you can afford to hold based on your score on our risk capacity survey. Well, I hope that helps you be a better investor, and I look forward to seeing you next time.